Inflation, a word that strikes fear in the hearts of economists and common folks alike, has been a major player in the global economy since 1971. Inflation at its core is the rate at which the general level of prices for goods and services is rising. But it's more than just an increase in prices. It's a reflection of the purchasing power of our money, a subtle tax that can erode wealth over time. The year 1971 holds a special significance in the history of inflation. It was then that the United States fully abandoned the gold standard, a monetary system where the value of a country's currency or paper money has a direct link to gold. With the gold standard, the health of a nation's economy could be readily seen in the gleam of its gold reserves. But in 1971, the US decided to untether its dollar from the constraints of gold, setting the stage for a new era of economic dynamics. Since that pivotal year, the story of inflation has been one of ups and downs, a tale as glittering and fluctuating as the price of gold itself. In some years, inflation soared high, making the cost of living skyrocket and putting a squeeze on households. In others, it remained relatively stable, giving economies a chance to breathe and grow. Simultaneously, the price of gold, once the backbone of our monetary system, has traced a fascinating path. At times it has soared, reflecting economic uncertainty and investors' search for a safe haven. At other times it has dipped as confidence in the economy grew and the allure of gold dimmed. The relationship between inflation and gold price is complex and multifaceted, a dance of economic forces that reverberates through our daily lives. From the groceries we buy to the investments we make, the shadow of inflation and the glimmer of gold are never far away. Indeed, the journey of inflation since 1971 has been a roller coaster ride, with its highs and lows closely mirrored by the gold price. The 1970s was a tumultuous time, marked by rising inflation and skyrocketing gold prices. The decade began with the United States fully coming off the gold standard in 1971, a decision that would have profound implications for the economy. This move essentially allowed the government to print more money, which in turn led to an increase in inflation as the supply of money outpaced economic growth. The inflation rate, which had hovered around 2 to 3% in the late 1960s, skyrocketed to nearly 13% by the end of the 1970s. This rapid rise in prices strained household budgets and caused widespread economic uncertainty. The gold price, on the other hand, experienced an unprecedented surge. With the dollar's value declining due to inflation, investors turned to gold as a safe haven, pushing its price from around $35 an ounce in 1971 to over $600 an ounce by the end of the decade. Midway through the 1970s, the world was hit with an oil crisis. OPEC, the Organization of Petroleum Exporting Countries, embargoed oil exports to the United States, causing oil prices to quadruple almost overnight. This not only led to long lines at gas stations, but also further fueled inflation as the cost of energy, a key input for many goods and services, shot up. In response to these challenges, the government implemented several policies aimed at curbing inflation. These included wage and price controls, which were intended to break the cycle of inflation but often resulted in shortages and inefficiencies. The Federal Reserve also played a role, adjusting interest rates in an attempt to control the money supply and, by extension, inflation. The 1970s, thus, set the stage for a new economic era, where inflation and gold price became key indicators of economic health. It was a decade of economic turmoil that taught us important lessons about the relationship between monetary policy, inflation, and the value of gold. These lessons continue to influence economic policy and investor behavior even today. Moving into the 1980s and beyond, we see a period of relative stability in inflation and gold prices. The 1980s ushered in an era of economic calm, marked by a notable decrease in the volatility of both inflation and gold prices. This stability was not a product of chance, but rather the result of deliberate economic policies enacted during this period. The Federal Reserve, under the stewardship of Paul Volcker and later Alan Greenspan, made a concerted effort to keep inflation under control. Volcker's tight monetary policies in the early 1980s curbed the rampant inflation of the previous decade, and Greenspan's careful management kept the economy on an even keel for nearly 2 decades thereafter. Meanwhile, the price of gold, often seen as a barometer of economic uncertainty, remained relatively steady during this period. After the golden frenzy of the 1970s, gold prices normalized and mirrored the general trend of economic stability. This era was also marked by the rise of globalization, a phenomenon that had a profound impact on inflation. As the world became more interconnected, the cost of goods and services began to equalize across countries. This global market competition helped to keep prices in check, further contributing to the stability of inflation. But let's not paint too rosy a picture. The period from the 1980s to the 2000s was not without its economic challenges. The savings and loan crisis of the late 1980s, the dot-com bubble bursting at the turn of the century, and the financial crisis of 2007 to 2008 all tested the robustness of the economy. Nevertheless, despite these difficulties, the inflation rate and the price of gold remained relatively stable, a testament to the effectiveness of economic policies and the resilience of the globalized market. While the 1980s to the 2000s were relatively stable, they were not without their share of economic challenges. As we entered the 21st century, new challenges and changes emerged on the economic front. In the realm of inflation and gold prices, the 21st century has been a roller coaster ride. The early years of the century saw relatively stable inflation, with gold prices on a steady upward trajectory. This stability, however, was shattered by the financial crisis of 2008. In response to the crisis, the Federal Reserve slashed interest rates and pumped money into the economy, leading to a spike in inflation. At the same time, gold prices skyrocketed, reflecting the uncertainty and fear gripping the markets. Then, just as the economy was starting to recover, another shock hit in the form of the COVID-19 pandemic. With businesses shuttered and unemployment rising, the Federal Reserve again turned to monetary easing to prop up the economy. This time, however, the inflationary impact was muted, at least initially. Gold prices, on the other hand, once again surged as investors sought safe havens. In the midst of these economic upheavals, changes were also afoot in how we measure inflation. The Consumer Price Index, or CPI, has been continually refined to better capture the true cost of living. For instance, the Bureau of Labor Statistics has introduced the concept of owner's equivalent rent to better account for housing costs. They've also adjusted the CPI to account for improvements in the quality of goods and services over time. These changes have not been without controversy. Critics argue that the new measures underestimate the true rate of inflation, particularly for essentials like housing and healthcare. On the other hand, proponents argue that they provide a more accurate picture of changes in the cost of living. Through all these changes, one constant has remained: the challenge of managing inflation, whether it's responding to economic shocks or refining the tools we use to measure inflation. The task of maintaining price stability is an ongoing one. The 21st century, thus, has seen a combination of old and new challenges in managing inflation. So, what have we learned from this journey through the history of inflation since 1971? We've journeyed through 5 decades of economic history, from the untying of the US dollar from the gold standard in 1971 and the inflationary turbulence of the 1970s to the relative stability of the late 20th century. We've also explored the new challenges and changes that the 21st century has brought with it. In the 1970s, we saw how the economy was rocked by an inflationary surge, driven in part by the decision to fully abandon the gold standard. This period was marked by economic uncertainty, with inflation reaching double digits and the price of gold skyrocketing. As we moved into the 1980s and beyond, a degree of stability returned, inflation rates moderated, and the economy grew, albeit with some bumps along the way. The gold price, too, experienced its ups and downs, reflecting the changing economic landscape. In the 21st century, we've been faced with new challenges. The advent of globalization and technological advancements have had profound effects on the economy and the measurement of inflation. The Consumer Price Index, or CPI, has evolved over time, incorporating these changes to better reflect the cost of living. Throughout this journey, one thing has remained clear: the intricate relationship between inflation and the price of gold. As we've seen, periods of high inflation often coincide with rises in the gold price. Conversely, periods of lower inflation tend to be associated with more stable or falling gold prices. This correlation underscores gold's enduring role as a hedge against inflation. From this historical perspective, we can glean important lessons. Economic policies, inflation, and gold prices are intimately intertwined, influencing and being influenced by each other. Understanding these dynamics can provide valuable insights into the potential future trajectory of our economy. Inflation, gold price, and economic policies are intricately linked, shaping and being shaped by each other in a dance that continues to this day.